Hello, everyone. Welcome to our year end of 2018 market and retirement planning update. The date of this recording is January 4th. Interestingly, as if you've read my letter, you saw that we've got some pretty positive economic news, especially related to the jobs and labor market. And the markets are responding very positively as we speak. So my goal here today is to provide a little context of what's happened over the last quarter, sort of see where we're at from a historical perspective, and try to give you some positive talking points for 2019, and hopefully we can see some positive results because of that. So what we'll do is we'll just review how the markets have performed over the last quarter and what went well and what did not. We'll talk a little bit about how most asset classes were negative for last year, which is kind of a rare occurrence, but not completely unprecedented. I've got a great example of some negative media bias out there and why we should be cautious of this. And then we'll lastly wrap up with changes to retirement account contributions, really just kind of qualified accounts as a whole. So we look back over the course of 2018, we did not see a lot of positive results. And quite frankly, I expected this at some point. I just didn't know when, and I didn't know how fierce it would be. I mean, really, we have one of the longest bull markets on record, which essentially means how long we go without a 20% correction. And so we essentially bursted that streak. And here we are looking back. Really, we see almost all, well, we do see all major equity indices that were negative for the year. Interestingly, really the best kind of fell in the NASDAQ type area, but it was actually the most violent correction in the fourth quarter. When we look at fixed income or bonds, they really didn't hurt us, but they really didn't help us for 2018. So across the board, it was really kind of a dud year. Obviously, there weren't any dramatic decreases, but there wasn't much in the terms of positive results either. And one of the big things I was hearing over the course of 2018 from media figures, economists, pundits, is that really the market was overvalued and we should correct because of that. Well, guess what? Now, as we stand here in 2019, based on most major valuation metrics, the markets now tend to be slightly undervalued. So we should consider that. The markets never really truly move just because they hit a certain valuation or certain metric, but it does provide sort of some context and some bias around where we think we are heading. And along those lines, we can see that S&P 500 operating earnings as well as profit margins continue to be at all-time highs and are expected to continue to increase. These are not signs of recessionary activity. It really looks like we are still in a strong economic and really just productive environment. And so we have to remember that when we're looking at the markets, we're looking at the Federal Reserve, rising interest rates, there's a lot more that goes into it, right? We've heard President Trump sort of bashing or calling out the Federal Reserve for raising interest rates because it's not fitting his narrative, right? The market went down, and maybe part of that is because of rising interest rate concerns. But as I said at the very beginning of this video, we just got some very promising labor and jobs related numbers. So it shows that in that regard, the economy is very strong, and that the interest rate increase we just saw here in the past couple weeks was very likely justified. And again, market corrections never feel good. I just want to continuously stress this so it kind of becomes ingrained in all of your heads, is that we can see that we did see some pretty big corrections in 2011 and obviously 08 and 09. But really, when we go back all the way to 1980, these corrections, peak to trough, are very normal. They're not fun, but again, they're very, very normal. And as we see here is that in 2018 was a rare year where almost all asset classes were negative, except for cash. Interestingly, in 2016 and 2017, basically all asset classes were positive. So this was probably expected. Now, I couldn't tell you when. It could have been 2019. But nonetheless, it's very rare that we see almost all asset classes negative in the same year. And this is showing the top 15. Actually, if you went all the way down to the top 40 asset classes, I believe 38 of them were negative for the year. So again, diversification didn't hurt you this year, but it didn't also help you. So it was just kind of a year, no matter where you were positioned, your rate of return or just overall portfolio return didn't change too much from one risk tolerance to the other. I came across this article or this little news story from CNBC, and it made me chuckle and shake my head. The worst stock market on pace, or worst stock market returns since the Great Depression. I mean, this is ridiculous. Yes, December did not start off to a great month, but as we know, just because the markets perform one way one week or the next, it has absolutely zero bearing on the following week. We are in no way, shape, or form anywhere near a recession, but yet CNBC is here trying to get us to click on the article, try to keep us engaged, try to scare us so that we rely on their news more. But this is just completely ridiculous. So it's stuff like this that makes it really difficult to be investors longer term, because we have that short-term negative sentiment out there trying to influence us in the wrong way. As I said at the very beginning, we did see a little bit of increase to 401k contribution amount. So employees can now defer up to $19,000 under 50 and up to $25,000 if we're over 50. So you get that $6,000 catch up. You can see that we got a $500 increase on IRA and Roth contributions, both pre-50 and post-50. And you also see the HSA contribution limits for 2019 listed here as well too. So if you're someone that's automatically sets this up and you want to max those out, we may need to adjust those numbers accordingly for you. So in conclusion, 2018 was kind of an interesting year. It wasn't all that painful, but it wasn't all that positive. So it's never fun to go through these periods. Unemployment's low, the consumer's healthy. As you saw, the labor and job force market is very strong. There's a ton of political divide out there, so we don't want that to cloud or influence our investment opinions or our long-term objectives because of that. So I know it's difficult to do, and you hate to hear me say this over and over again, is we need to have patience. You don't always have to do something. So with that, make 2019 a great year, and I look forward to seeing and talking with you all soon.